So everywhere I turned over the weekend, there was an article here, research paper, something about AI robots taking jobs at a blistering pace. So once again, I'm pondering whether it's possible to have a jobless prosperity. I know it sounds oxymoronic, but when do the disappearance of potential consumers get offset productivity gains? So 2 weeks ago, my next guest was part of a research team that published Why Wall Street Wisdom regarding stocks and rising unemployment is wrong. I'm going to bring in now Piper Sandler, Chief Investment Strategist Michael Kantrowitz. And, you know, we're going to put up on the screen here the conventional wisdom versus reality. Sure. But before we get to that, you know, at some point, do you think, you know, and we're seeing it everywhere. I referenced the Amazon 600,000 manufacturing robots. I don't know if that equates to 600,000 jobs, but how good can it get for corporate America before you say, well, you know, there's not enough customers left?
I think we're well away from that.
A long ways from that.
Yeah, we're a long way from that. And it's happening, I would say, at a glacial pace. I don't think AI replacing employment is broadly a systemic problem for markets that they need to face in 2026, but down the road, potentially.
You and I talked about this a little bit. I want to bring it back up, though. The conventional wisdom in the street, you know, saying, okay, unemployment's going to go up. That's not good. Stocks always go down in a recession. Higher unemployment is bad for housing and stocks, and market leads the economy. That's always, and it always falls before recessions. These aren't necessarily true, right?
Not necessarily, and certainly not all the time. I mean, just the idea that, you know, when we see unemployment rise, it's necessarily bad for stocks. I think, you know, obviously in 07, that was very much the case, and it was the recession prior to that in 01. But when you start going back in history, beginning in the 1990 recession, and go back and look at the last 6 prior to that, in 5 of those 6 periods, it was actually higher unemployment that I think helped make the stock market go up, because you were at a period in time where people were so worried, similar to today a little bit, about high rates and high prices. So as unemployment started rising and allowed rates to come down and lift the market. Does this sound familiar?
Right. Sounds like, yeah, sounds like we might be in the midst of that right now. We are in the midst of earnings season. Yeah. Your thoughts so far?
Earnings season looks good so far. I mean, we're seeing, we're still just about halfway there. You tend to get more beats early in earnings season, and then companies start to adjust, and analysts adjust their expectations in week 3 and 4. So those tend to come down. But either way, we're looking at a pretty solid backdrop. More importantly, for the last 3 months, we've seen the broadest improvement in earnings expectations since 2021, alongside some green shoots in both housing and other macro data. So we think that we're in a backdrop for earnings breadth to continue sustainably improving into 2026.
One of the charts you had, the large and small cap calendar year earnings estimates, I mean, even for 2027, it's making a nice move higher, you know, this sort of turn. Yeah. I mean, can we go out that far with any confidence?
The confidence is, my view is markets don't really look so far ahead, and those estimates tend to be an extrapolation of what markets and investors know today and expect in the future. So you tend to see parallel shifts, but that's the forward-looking component. And if the current backdrop continues to look healthy, the forward backdrop will reflect the same.
Small cap optimism within the margins. The margins are looking better here. Now, you use the S&P 600, though, right? Yeah. I mean, is that deliberate over the Russell 2000?
Yeah, we're trying to actually be more conservative, using a more high-quality benchmark, because there's so many names in the Russell 2000 that it's so heavyweight towards biotech and non-profitable companies that there's a lot of funky data when you look at the aggregates. If you look at the 600, it's a much cleaner and more comparable number to the S&P 500, because they use the same methodology.
Is that an area, though, that people should be considering? Is that an area you like right now, small caps?
We've been relatively bearish on small caps up until, I would say, about 4 or 5 weeks ago. And I think, yes, looking into 2026, investors want to broaden out beyond the Mag 7 because we see a better macro backdrop, better earnings breadth, all occurring actually while still soft employment and lower interest rates, which I would call a Goldilocks backdrop.
So, and one before I let you go, so we got the Fed. I know that Nancy Lazard talks a lot about the big, beautiful bill and the policies taking. I'm sure you're in the same camp that we get these additional sort of tailwinds for that, not just for the economy, but possibly for the market next year too.
Absolutely. You know, there's markets reflect policy like changes in the Fed funds rate twice. They reflect it when expectations are changing and when the Fed does something. Right. And then about a year later, 15 months or so, the variable lag shows up in the economic and earnings data, and it gets rewarded again. Of course, it works on the flip side as well, but we see a lot of green shoots into the momentum of the economy looking out.
We'll take those 2 bites at the apple. Michael, thank you
Absolutely.
very much. Appreciate you.
My pleasure.